A lot of concerns surfaced during the third quarter of this year and weighed on financial markets. Concerns about the state of the global economy. The Chinese economy is slowing down much more than expected. We had a US soft patch during the third quarter of this year. Japan is close to recession and emerging markets are exhibiting a lot of weakness. That led to a slew of earnings downgrades, and on top of that, emerging market sovereign funds were net sellers of financial securities. That led to liquidity dry up and risk premium rose and markets went down. But nevertheless, we think we have seen the lows for the year. We had a successful retest of August lows beginning of October. Commodity prices are stabilizing, and that is very important for the sentiment. Emerging equity markets, clearly the weak spots this year, are rebounding nicely, in line with developed markets. And don't forget that we have extremely dovish central banks ready to inject more liquidity into financial markets. We are positive on equity markets for the rest of the year. In a low growth environment, we continue to favor growth stocks. In that space, we find a lot of companies leading the digital revolution. What is the digital revolution? It is about data management, mass custom ability, and scalability. If you can find companies able to provide a personalized service or product to a wide range of customers, that company will take away market share from traditional competitors with traditional business models. We find these companies mainly in internet media and in the consumer sector and consumer finance. We also like providers of the infrastructure for the digital world, and we find these companies mainly in the IT sector, like software providers. So all in all, we like most of the IT sector and growth stocks more generally. European equities could do well for the rest of the year as well. Liquidity is improving, earnings expectations are lower, the technical picture is clearly improving, and valuations are back in line with the 20-year historical average. So there is potential here to go back to the highs we have seen in the second quarter of this year. Fixed income markets, they are very expensive currently. Nevertheless, we don't expect long-term rates to go up by much. Where we find some good balance between risk and return, despite the fact that the quality is a bit lower, is on the US investment-grade corporate debt market, where you have yields a bit higher than the rest of developed markets. And due to the positive slope of the yield curve, you have a roll-down effect, which is adding up to your expected return. Finally, the high-yield bond market. There, despite that the quality as well has gone down a bit, the carry is very important. The spreads are pricing a level of default rate which is way higher than what you could expect in a growing economy. And that is why we think that the high-yield bonds, a diversified position in high-yield bonds, has its place in a bond allocation.